Let's establish what we're actually talking about when we say whale accumulation. This isn't some mystical crypto concept, it's basic supply and demand warfare at scale. A whale accumulation phase happens when large holders systematically purchase significant quantities of a token, typically during periods when retail is capitulating or disinterested. They're not market buying like you do with your $500. They're setting limit orders across multiple exchanges, using OTC desks and positioning over weeks or months. The recent Pi Network example makes this concrete. One whale wallet accumulated over 5 million tokens in under 48 hours. That's not emotional buying. That's calculated positioning with specific price targets and exit strategies already mapped out. But here's what retail misses. Whale accumulation isn't automatically bullish for you. It's bullish for them. They accumulate low, create momentum through continued buying, retail FOMO kicks in, prices spike, and then they distribute into your buying pressure. The largest Pi Network whale now controls 376 million tokens valued at approximately $82 million at current prices. To put that in perspective, if they decided to liquidate just 10% of their position, that's $8.2 million in selling pressure hitting the market. Most altcoins can't absorb that without significant price impact. This concentration creates a fundamental power imbalance. Retail investors, you, me, everyone watching this video, we're collectively taking the opposite side of trades against entities with $100 million positions. They have information advantages, capital advantages, and time advantages we simply don't have. Now let's address the question nobody's answering. Who is this whale holding $82 million in Pi? There are 3 possibilities, and each has dramatically different implications for your investment thesis. Possibility 1. It's an insider, someone connected to the Pi Network team, early developers, or founding members who received allocations before public availability. If this is the case, their selling behavior becomes even more significant because they have perfect information about project developments, timelines, and potential issues. Okay, so, possibility 2. It's an institutional player. We're talking about a fund, a market maker, or maybe a large trading entity that accumulated through over-the-counter deals or, early exchange access. These entities usually have shorter time horizons and some pretty specific return targets. Once they hit their numbers, they exit, no matter how bullish your thesis might be. Now, possibility 3. It's an early adopter whale who mined or earned tokens through the mobile app ecosystem before most people even knew Pi existed. These holders often have an extremely low-cost basis, which means they can sell at prices that would totally wreck your portfolio and still walk away with like 100 or even 1,000 times their original investment. The uncertainty around whale identity isn't just academic, it's actually critical strategic information. If you don't know who holds the largest positions, you really can't anticipate their behavior. And, if you can't anticipate their behavior, honestly, you're trading blind. Meanwhile, the Pi Network team continues pushing ecosystem development. The Pi App Studio received updates designed to streamline developer experience and accelerate decentralized app creation. In theory, this expands utility and attracts users. In practice, whale distribution can completely override any positive fundamental development. You can have the best technology, the strongest community, and the most impressive roadmap. But if a whale decides to liquidate $20 million worth of tokens over 3 days, none of that matters in the short term. Price gets destroyed, retail panics, stop losses trigger, and by the time selling exhausts itself, the damage is done. Quick time out. If you're starting to see how whale dynamics actually work instead of the simplified stories you've heard, hit that like button right now. And if you want me to keep breaking down these institutional level strategies in language that actually makes sense, subscribe to TJ Crypto World and turn on notifications. This is the kind of analysis that separates profitable traders from exit liquidity. Alright, let's get practical. How do you actually detect when a whale is preparing to distribute? Signal 1. Exchange deposit spikes. When large amounts of tokens suddenly move from cold wallets or unknown addresses to exchange deposit addresses, that's preparation for selling. Whales don't send tokens to exchanges just to hold them there. They're setting up for liquidation. You can track this using blockchain explorers. Look for transactions moving millions of tokens from wallets that have been dormant for months. When that dormant supply suddenly activates, distribution is coming. Signal 2. Accumulation stalling while price stays flat. If you see whale wallets stop adding to positions but price isn't declining, that means they're finished accumulating. They've reached their target allocation. The next phase is waiting for retail to create the liquidity they need for exit. Signal 3. Positive news with weak price response. This is the most subtle but often most reliable indicator. When genuinely positive developments occur, major partnerships, exchange listings, protocol upgrades, and price barely reacts or dumps shortly after, that's whales distributing into the news. Retail reads the headline and thinks this should pump. Whales already knew about the development weeks in advance, accumulated in anticipation, and now they're selling you the news you just discovered. For Pi Network specifically, watch how price responds to the App Studio updates and any future ecosystem announcements. If the news is legitimately positive but price action is weak or dumps within 24 to 48 hours, that's your signal that large holders are exiting. Now let's talk about the factor that could force all this whale activity into the open regulation. The European Union's Markets and Crypto Assets Regulation, MiCA, creates new compliance requirements that could directly impact how whales operate. Under MiCA, certain token holders may need to disclose positions, transactions, and even identity information depending on how Pi Network is classified. You know, this matters because anonymity is a key advantage for whales. When you don't know who holds large positions, you can't predict their behavior, and when regulatory frameworks force disclosure, well, that information asymmetry narrows. However, MiCA compliance also creates costs. Smaller participants, both individual investors and small businesses, may find the compliance burden too expensive to justify continued involvement. This could actually increase whale dominance if retail participation decreases, while large holders can afford compliance infrastructure. There's also the privacy risk dimension. Regulatory frameworks that demand transaction monitoring and reporting create surveillance infrastructure that affects everyone in the ecosystem, not just whales. This could push some holders to exit entirely rather than operate under increased scrutiny. For Pi Network, regulatory classification remains unclear. Is it a utility token, a security? How will different jurisdictions treat it? These answers will determine what compliance obligations exist and who can practically participate in the ecosystem long-term. The regulatory landscape creates a paradox. It could force whale transparency, which is good for retail, but it could also drive retail participants away through compliance costs. Honestly, that's good for whales maintaining dominance. So how do you actually navigate this environment as a smaller investor? First, accept reality. You cannot compete with whale information, capital, or timeline advantages. What you can do is recognize their patterns and position accordingly. Don't try to outsmart them, just don't become their exit liquidity. Second, watch on-chain data religiously, set up alerts for large transactions, monitor exchange flows, track wallet distributions. This information is public and free. Use it. Third, be suspicious of perfect setups. When everything looks bullish, when all the indicators align, when the community is maximally excited, that's often when whales distribute. They need your enthusiasm to create the buy-side liquidity for their sells. Fourth, take profits incrementally. Whales don't sell their entire position at once, and honestly, neither should you if you're fortunate enough to be in profit. Scale out as price rises rather than trying to time the perfect top. Fifth, understand that whale games aren't fair. They never were, they aren't now, and, well, they never will be. The question isn't whether the game is fair, it's whether you can still win despite the structural disadvantages. And there's your complete breakdown of whale dynamics in Pi Network. Crypto fam. One wallet holds $82 million. Another accumulated 5 million tokens in just 48 hours. These aren't random events, they're calculated moves by players with advantages you don't have. Your edge isn't capital or information, it's awareness. Understanding how whales operate, recognizing distribution signals, and refusing to become exit liquidity is how smaller investors survive. If this shifted your perspective on how crypto markets actually function, smash that like button and subscribe to TJ Crypto World. I'm consistently breaking down institutional strategies that most crypto channels won't touch because it doesn't fit the hype narrative. Before you go, check out my video on identifying distribution patterns across altcoins. It's the perfect complement to today's analysis and will sharpen your ability to spot when large holders are exiting. Until next time, stay skeptical, stay informed, and remember, in crypto, the obvious trade is usually you becoming someone else's liquidity. This is TJ, and I'll catch you in the next one.